Hi, this is Randy Finney with the Right Side of the Chart, and today is Friday, May 24th, 2024. It's 11:51 a.m. Eastern Time, so I'm starting the video, and I'm going to update things a little bit in reverse. We'll do the equity markets last. I just wanted to cover. Here's how I'm going to go through things. We're going to do a quick update on the precious metals. I'm going to include one that is a potential long and/or indirect hedge to GDX or gold or silver short, and that would be platinum. So I'm going to go through in this order. We're going to look at GDX, quick update on the metals, or the miners, I should say. Platinum, I'll throw that out there. Interesting looking chart right now. And then just kind of just a few of the what I call kind of tells, economic indicators. Let me add one here. I have KRE, the regional banks. I'm going to just touch on XLF very briefly. Brief overviews there. That's the banking sector. Does not have the weighting mathematically on the indexes that technology does, but certainly probably every bit as important to, especially more important to the economy, if you will. Tech's more important to the stock market and the indices, whereas the banking sector is certainly more important to the overall health of the economy. So I'll get to that. And then those kind of quasi-economic indicators I look at: PAYX, ADP, UPS, FedEx. Oh, let me make a note. Consumer sentiment was out today. I want to talk on that and why the market's up. Let me just write that down on my notepad here. All right, so those things. And then we're going to take the video home with a quick update on those stocks that I highlighted yesterday that put in the bearish engulfing candles, including the two indexes, the main ones, QQQ and SPY, and then a brief overview of the Mag 7. I know it sounds like a lot. Maybe it is. You know me, if I get too far in, and I'll just truncate it and cover the markets in the second part. Let me just do the brief updates let me start in that order I just gave you, and that way you can skip ahead if you're not interested in any of these. So for all intents and purposes, GDX hit T1 and bounced. It's nothing more than a reflexive bounce. Remember, I often state repeatedly that the targets that I give are the actual support levels that are price targets, and I always personally, and I suggest covering a little shy, and when you're shorting, a little shy of support that you're targeting in case the sellers step in early. It's very common if it's a very obvious support level. Quite often shorts will take profits early and longs will start stepping in early. So you always want to cover a little bit before that. Ideally, likewise on long trades, you want to sell a little shy of the resistance level you're targeting. So, nothing much. 1% bounce, so we reversed just above that T1 level. Might even hit it in the after hours or a pre-market session. I don't have those trades turned on. You know what, I can do it now. I'm just curious myself. Pre-post data always show last two sessions. Came again even a little closer. So there it is. Let me turn that off. All right, so there's your update on GDX. Really no change, guys, at all since the videos I did yesterday. I could go through quite a few of those. We do have some of the big miners still at those key trendline support levels I gave you, and a couple others taking them out. So that's there's your update on GDX. And I still, suspect we're going to go lower. Any pushback to about that 36-ish level would be an objective short entry. You have a potential downtrend line here I'm going to add right now, as would that. So, this is where, it starts to, it doesn't completely foil it, because when you break down from a wedge, sometimes that's it. You always have an initial reaction. You're going to have counter trend rallies on any move, and you could still come in and back test the uptrend line. The uptrend line, the bottom of the wedge, or you could stop at this downtrend line in 35.78. I'm giving you levels that are likely to come into play, and likewise, if you break above there, you're probably going to run up and maybe do a full back test of the wedge, and maybe that's it. Maybe it was a one and done pullback. That would be unlikely. Again, corrective waves are usually at least an ABC, so that's what I still favor. Now, on a somewhat related note, platinum, you can have an ETF called PPLT. It's the physical platinum shares. Nice support level, and I have a support level also. Why is that support? Let me just say, because you had a major distinct reaction high there, and you have also reactions here. A reaction high, you pulled back, and then there was a gap up to that level. So there's three reactions right there. Now on the flip side, we did just break down. We are coming off a divergent high. So I want to say I'm not I don't have strong convictions on this, but I'm going to show you a setup that shows better on the futures. But last time we had a 60-minute divergent high, we got that. The time before it, we got that. We had a divergent low here, and we got all of that. And not really a divergent low there, but we had a rally. So there, we're just coming off this divergent high, and then we did just break that uptrend line support. So we could get a kickback rally. It could cap there, or we could continue on up. When you look at the daily chart, we're back testing. This is that support level right there, that previous reaction high. We're in an uptrend. Remember, we're coming off on the daily, a big divergent low here. We're in an uptrend. Uptrend simply defined as a security making higher highs and higher lows. And so far, that's what we've done. So I wanted to point that out. Getting a little stretched, to say the least. Quite overbought, extreme overbought readings. But let me show you what the futures look like. PL are your symbols for platinum futures. And there's a nice clean uptrend line, the same one I just showed you on the ETF, the same divergent high here on the futures. Remember, the difference in the futures are just trading around the clock. Last divergent high, I don't have it all drawn out because these futures keep rolling, so my lines go away every time there's a new contract. I've got to redo the lines. But, it's simple stuff, guys. I'm like I said, I'm not a pure mechanical trader, but for the most part, look for divergent highs, look for divergent lows to rally, divergent low, rally, divergent high, correction. Divergent low right there, cleared, positive divergence, rally, right? Divergent high, correction. And so far this correction is smaller than these previous two right here. You had one that certainly was longer in time, a little bit longer, about the same in price. But we do have this now divergent low. So like I said, it's kind of a little bit conflicting information. Don't give me any comments on that. Like I said, I'm telling you I don't have strong convictions, and I'm showing you what I see here. So there's that divergent high, but this gives you a little bullish falling wedge, and you're, like I said, in a larger uptrend. And so we I'm going to tweak this line as I'm doing the video just to make sure it's nice and crisp and tight. Let me zoom in a little bit and make sure that we're above there, because we might not be there. Yeah. The best I can draw it is right there, but it's not an impulsive breakup. Put it this way, we're right on the line right now, exactly on the line. So if it can pop that, then you are probably going to go up for that back test. There's some price resistance there, and I'll call it an indirect hedge because believe it or not, although the platinum and palladium, platinum is one of the palladium groups of metals, the platinum and palladium don't have a super strong correlation. Sometimes they're actually inversely correlated. There's a very low correlation to gold and silver. Gold and silver have a very high correlation, and these guys a little less. So again, you can take it as a pure play if you like it. Maybe there's going to be more. Maybe this is it for the correction. I'm showing you right here is a bullish falling wedge pattern. So if we can regain the trend line, yeah, we're probably then going to go to new, at least near-term highs there. And so, like anything, there's support. We hit support. I just zoomed out, but I showed you on PL. It's the same key reaction high right there. And so, that would be an objective level for a stop loss order if you do decide to take this one long. Alrighty, let's roll into, that's it for the precious metals. That's all I wanted to update there. Let's go into the regional banks. Like I said, benign KRE, and don't hear, I don't hear anybody talking about it, because the only times I ever turn on the TV, Bloomberg or CNBC, is when there's a market moving report or economic release or big earnings. And so maybe, I don't know, maybe they're talking about it. I kind of live in my own little vacuum, my own little world. But like I said recently, this is the primary bear market downtrend line. Make no mistake about it. These guys are in a bear market. They're making lower lows, lower highs. This is all they got after a bailout, the biggest bailout in decades, or really one of the biggest bailouts in history, with the Fed backstopping the regional banks. And that's all you got there. So it's well known fundamentally. If they didn't have the backstop from the Fed, and they had to recognize all the losses on paper that they have for the underwater long-term treasuries, then they'd be insolvent. But they're not. But however, doesn't matter. Technicals, we can sit here and talk fundamentals all day long. That's not my, I'm not an expert regional bank analyst, but Even though I've worked for almost a half dozen of them in the past. But that's what I can tell you definitively, because this is my wheelhouse, technical analysis. We just got rejected off the bear market downtrend line, and I did an extensive video on this, and I'll just rifle through a few, just in the largest ones here. TFC rejected at resistance, but currently backtesting the trend line. So it's still kind of just a wait and see thing for me. It's both market. I'm doing this both as potential trade ideas, and there's, like I said the other day, there's nothing wrong if you wanted. There were a lot of these at resistance when I covered this. They're all profitable if you shorted them. So they are trade ideas, and you just short with stops above those resistance levels I highlighted the other day, such as 4065 on TFC. But TFC Truist is backtesting the primary downtrend line now. So, if we continue to move lower, we're going to start breaking support levels that, quote unquote, doing my little finger air quotes, quote unquote, the buyer should be stepping in. When you take out a downtrend line, that's bullish and come in back test. So, the bullish scenario would have a successful back test, meaning we rally off this back test and then break 40.65. And if that's the case, we're probably going right up to 45.62 right there. However, should we get rejected, and that's what I favor because of the charts, these negative divergences, and we break that means it's a failed breakout, number one. This recent breakout, that's very bearish in my opinion. That's going to send us down. This is critical support. This is where the regionals were all about to collapse, and Fed stepped in and saved them, and then they had this trading range after a while, and then it broke out. So it's a very, very key support level there, quite bearish below it. And it's, it's pretty much lights out. We already know the Fed's not going to let them go to zero, but they could be, there could come a point, Fed's trying to reduce its balance sheet, and there's only so much they can do. You start to get pushback. And so, it is possible that, they're effectively bailed out, but then shareholders get wiped out. They didn't do that in the financial crisis when they should have, but, either way, keep that in mind that, you could see these stocks go down, and then the Fed keeps the lights on, for the regional banking sector. A lot can happen. All I can tell you guys is what the charts say, and those are the technical levels to watch. I won't go through each and every one, but MTB broke down. I've added a few trend lines to some of these. Remember, MTB was at resistance there, an objective short at 156.84, and now it's broken that minor trend line there. HBAN, Huntington Bank shares, big bearish rising wedge pattern, and it's right at, again, I've added a couple trend lines that I might not have had in the last videos. That's why I'm kind of expanding on this. There's your bearish rising wedge, the two lines I just drew. And like quite a few others, it's also backtesting the primary trend line. So at this point, if it breaks both of those, it's going to break the wedge, and then this whole thing right here will be a failed breakout. That's going to be bearish. It should send Huntington in quick order back down to at least 1234, and then you've got those previous lows there. And again, the 1234 is a key level. You had that big W bottoming pattern right there, and breakout, and so that would be quite bearish and break under 1234. So again, sell signal 1 right there, break failure of the wedge and the downtrend line, and then 1234. And the rest, you can see this one's already broken down from its wedge, breakdown back test. That's Regions Financial, RF, Citizens Financial, right on the bearish rising wedge. So again, something that definitely worth monitoring, because mark my words, you will, if these all start to break down, you will start hearing about it on Bubble TV. They will be talking about problems again with the regional bank sector, or not, guys. Or guess what happens? Everything I say, if it happens in reverse, then it's bullish. If I say, well, this will be bearish, then obviously the inverse holds true. If they can power on through here, and this one broke out, and it's above the primary downtrend line, and it can take out, and then can keep moving up and take out these negative divergences and run up here, then guess what? The regional banking sector is in better shape than it appears to be right now, or it is at this moment, I should say. All right, I won't go through them all. Again, I did an extensive video recently. That one was the first target there, I believe, on EWBC, East West Bank. We had a bearish rising wedge, hit the first target, 71.05, bounced as expected. And if and when it takes that out, simple stuff. Bearish, if that target's taken out, which I favor based on this pattern of the wedge, the measured target itself should take it down, below that level. And then, of course, bullish if it pops this resistance level, about almost 80 right there. You got a major reaction high there. It were the major highs back there. Broke it, tried to get above it, couldn't hold it. Once the street realized that the markets realized that this failed, and it failed because it was negative divergence at that high right there, and then boom, the rest happened there. So big level resistance overhead, already on a breakdown, sell signal, support just below. And so simple. Bulls win above there, bears win there, and they especially win if that 63.57 level goes. So didn't mean to do that one, but I'll get to that one second. FHN, First Horizon Corp, negative divergence. WBS, see, a lot of them are coming up on trendline support, key levels. So again, a sector that I'll continue to monitor, and quite a few have already broken down. So not a really too much support below to make aggressive trade on these right now. But certainly the case was made to make an objective short entry and then just wait to add to it if that's what you're doing. I think once those other levels that I just showed you, the support levels below, go. All right, let's move away from that. Let's just touch on their big brothers, the big financials. That's XLF. Remember XLF put in back here, bearish engulfing candle, just made it ever so slightly new divergent high. I just updated this the other day. And then I highlighted this uptrend line right here. And there it is, breakdown. It's been moving lower since, so that was a big divergent high. Divergent high 1 after the primary trend line break there, correction 1. Looks just like kind of like QQQ, made a marginal new high, but still a divergent high, and moving lower now. And so based on just the technical posture, I still favor quite a bit more downside. But the way it works, you got to take out 40. I'm going to move that line right now, guys. It should be right there, about 41.19. Why? Why did I do that? Support here, resistance right there, reaction highs, then a breakout candle, rallied up. And so now if it breaks pretty much yesterday's lows, that was an older level I had as an important level, probably not so much anymore. What now matters probably, I can say certainly more, would be, I think that's important right there, about 40.60, but let's just put it at that recent low, and let's just set an alert just in case these guys drop off my radar. And then the big names, JP Morgan, still coming off that divergent high and a massive bearish engulfing candle recently. Still well below the top of that candle, and so that's a pretty strong sell signal in my opinion. I gave it as a short trade back here. We hit T1, bounce as expected, made a marginal new high, and so I still maintain these deeper targets down here, T2, T3, T4. Visa, another one. And again, Visa is very much a tell on the economy. I covered that one yesterday, so I'm not going to go into any more detail on it. It's that resistance just overhead, but just like MasterCard here as well, the two big credit card companies are, broke down from these rising wedge patterns with divergent highs and have been stair-stepping lower. And so, again, the financial sector is looking bearish and toppy to me. That's it. So, and it won't matter, to the masses, to the vast majority. This is nothing more than just a correction in an uptrend, and that's all it may prove to be. I see it otherwise. I see the probabilities favor that this was a significant top, and there's going to be more downside to at least this level here. And this is where you're going to start hearing them talk about it on TV. The so-called experts are going to come out in hindsight and talking about the problems, what's going on with the banks and blah, 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 if they get down there. So right now, it's just, probably viewed as most as nothing more than a healthy pullback, buying opportunity, blah, blah, blah. But it's incremental, guys. So at this point in time, watch these recent lows. That's when, the stops will start to get hit for those that bought the dip. And you get the 200s there. If the 200s get taken out, that's another red flag. And you can see my, next target down there, about 418.40. All right, I won't go through each and every one. Bank of America, beautiful little rising wedge pattern. Berkshire, the key level there, 399, call it 400, I'm sorry. Uptrend line, massive, just massive support right there. Very powerful sell signal if and when that comes. So I think I already have an alert. If not, there it goes. I'm going to make sure I do. It doesn't hurt. There's a couple reactions below the 400 level, about 395. So you want to play it safe. I'm going to do it right now. That's where I'm going to put my alert there as well, price alert on that. All right, let's move away from that. You know my outlook, you know the technical posture, and again, it all works in reverse. You know, you've got a trading range here. If they can pop above, you had a bearish engulfing candle there, the top of which is right there. So, you know that's going to be bullish-ish, if that makes any sense. Bullish-ish. Why? Because it's just going to, if it happens anytime soon, I'm going to extend these lines out. It's going to be a breakout to a new high with overbought conditions and negative divergences. And again, it doesn't guarantee a reversal, but it to me, it guarantees the probability favors a reversal, if that makes sense. So that's what it would look like there. So appears that, you know, again, the financials are looking toppy. All right, let's move away from that. A couple of the ones I just recently updated my, you know, there are my things to watch list, the kind of the economic indicators, the kind of tells on the market, PAYX, one of the two giant payroll, the biggest payroll processors, still and getting rejected off that downtrend line I highlighted the other day when it was testing it. That's our bear market downtrend line. Why is the stock market making new highs when the payroll companies peaked back in 2022? Doesn't make sense. You go back in history, you're going to see when that happened before. Eventually the market rolled over. Now, maybe it's just a corrected, you know, if we do this, then that's going to show you that, hey, payroll, you know, these companies are picking up. They're seeing more business. More and more people are hiring, putting more people on the payrolls, but that's not the case right now. So watch this. You get rejected, and it's going to keep that downtrend going. Purple level is still the big number, and we're way away from it. We're well above it, but that's 105.79, meaning kind of lights out. When that happens, if and when that happens, we'll be in like, stock market will probably be in pretty much meltdown mode or hard selling mode. So I think I have an alert set, but I'll just do it as well. And the other one, even bigger, is ADP. Same thing, at downtrend line resistance. Should it pop that, it's got pretty substantial price resistance just overhead at about 257. And if it equals that level, it'll equal that previous high or any marginal new high anytime soon. It will be guaranteed to be a divergent high, and then what that means is that breakout will likely fail because of the divergence, and that's my take on ADP. And again, big. And then the other two ones, big ones, are UPS, which I covered recently, still testing that key 138.46 level. Again, you go back in time and history, as long as UPS and FedEx have traded, you will not see them have peaked 2 years prior to a market high. When they peak, that's it. Usually they peak first and the stock market drops. Again, they're, in my opinion, very good economic indicators, and both of them peaked back in 2021. All right, what do I have here? All right, let's talk the stock market. Stock market's up today. QQQ is up. Breadth is healthy, just as good as it was bad yesterday. So maybe yesterday proves to be a one-day wonder. Maybe not. You know, it did happen. And I'll get to where we are now and how things look. So what happened today, you know, you hear me talk all the time about, you know, in economics, you know, macro fundamentals. There you have lagging indicators, coincident indicators, and leading indicators. And some consider, well, I consider consumer sentiment at best a coincident indicator, if not a lagging indicator. You can blindfold me, show me what the stock market's done for the month, and I'll tell you if consumer confidence is going to come in higher or lower. Consumer confidence goes up and down with the stock market. So there's very little predictive value. Next time the stock market drops 10%, mark my words, consumer confidence is going to go down that following month when they report. Or whatever, you know, weekly or monthly report you're looking at. So what happened today is, 1 second. This is a 1 minute chart. You're looking on QQQ, so that's where we closed yesterday. There was a small, relatively small gap up right there. And the markets traded sideways, started going down, a little fading the gap, and pretty much went nowhere again up. And then a huge candle. When was it? It wasn't coincidence. It was at 10 a.m. What happened today? There were two economic potential market moving reports this morning. Flip, that's natural gas. I'll get to that in 1 second. Here's the economic calendar. This is Friday right here. You had durable goods at 8:30 that really didn't move, was kind of a non-event. And then consumer, and that's usually the one that has a higher potential. And then consumer sentiment. And you can see consumer sentiment consensus was 60. No, you can't see it now until I zoom in. 67.4. That was the low end of the range as well. That makes, I don't know why consensus was in the consensus low end of the range. Doesn't matter. Prior was the same number. Came in better than expected. Surprise, surprise, surprise. The stock market just recently hit new highs, and consumer sentiment came in better than expected. And the market rallied on it. And so again, this is, it's kind of a vicious cycle. It really is with the stock market. Consumer sentiment goes up. Buying begets more buying, whereas selling begets more selling. So that's, again, and again, as I said, this is a coincident indicator. To me, it's kind of silly, but whatever. Silly is whatever. People want to buy because they see a better than expected consumer sentiment number. That's what happened, and that's the reality. I just wanted to make clear that was the catalyst for today's rally. We were going sideways, and once they saw that number, the market rallied. So now let's talk a little more. Let's get a little more granular. So this is the wedge pattern that we had, the pre-NVIDIA whipsaw and post-NVIDIA whipsaw, which one's the real whipsaw up, but we're still below it. So like I said, that was just immediately before earnings, right before the close. That was right after the open. Both of those were kind of just the noise. And like I said, the noise tends to abate after a day or two of trading, and then the market will pick its direction. All I can tell you definitively, we're still below the recent high. We're still below the breakdown, right where we broke down yesterday, or we're below the wedge, I should say. That's most important. You have numerous reactions there. And that's QQQ. This is SPY. SPY, you had the uptrend line here, the divergent high. You had the breakdown right here. A little snapback rally that extended the divergence and actually gave you what we didn't have before. When we had this, now we have this clean divergence here, and that's pretty much, it's really it's a sideways trading range. We're not going anywhere in the last week or so, at least the last few days. Let me show you the futures. They look a little clearer to me, those charts. NQ, NASDAQ 100 futures. Again, this is your wedge. There's your divergent high right there, negative divergence. There's your breakdown. I had a yellow line, meaning that was a very significant support, more important than the 18,709 above it. Why? Because that was the top of the multi-month trading range we had from January, I think it was February to April, right there. So very, very well defined. And this was a breakout of it. And that's the initial back test. I would have been shocked if they didn't at least have a little reaction there. And so far, we've had a decent reaction, but we're still below the wedge. So it's still, the sell signal we got yesterday is still intact unless we take out, regain the uptrend line. We may go in for a back test, and if we do, as long as it happens soon, and by let's say Tuesday, remember the markets are closed Monday, or today, it's still going to be, even if we back test higher than yesterday's high. Again, if we do much more than that, the divergence will be taken out. Otherwise, the divergence will still be there. And I'm going to get to the bearish engulfing candles in just a second. Let me just cover ES. ES, the S&P 500 futures, same thing. Uptrend line, divergence lines right there. There's your negative divergence. It's been building on ES for a while. Breakdown, hit that 5308 support level I had, bounced, made a perfect back test. Went down, took it out, and we're bouncing today in sympathy with the NASDAQ and the tech stocks. So let's now shift over to the bearish engulfing candles that I talked about yesterday. I already mentioned, I checked, internals are positive today. Again, down yesterday. I said yesterday, one day doesn't make a trend. But price action is always first and foremost. So let's look at that. So QQQ. Still comfortably above yesterday, the top of yesterday's bearish engulfing candle. So had you shorted that yesterday, or even better, I'll say this now, since we're still below it, in my opinion, some may not want to hear it, it's even a more objective, a better short entry now. Might not be any more objective. It already happened and it hasn't been taken out. but the bottom line, the price point's better. It's like buying in reverse. When you buy something, whether it's a TV at Best Buy or a stock, you want to buy it at the lowest price possible, the best price. And when you short, it's opposite. You want to short at a higher price because you're betting it's going to go down. So all I can tell you is we're still below, comfortably below the top of yesterday's bearish engulfing candles there on QQQ. We're also below the trend line, as I pointed out. This is the same trend line on the 60-minute chart right there. There's a breakdown candle, nice red and impulsive like you like to see. And so nothing's changed there, and same potential targets there. And the same very high probability, or I'm sorry, maybe not the high, a decent probability. I like these bearish engulfings. I like where they came in from yesterday. I liked everything I saw. But again, it's so simple. They get taken out. And like I said, you want to give it a little room because that's what the algos do nowadays. And these things have been around for years, bearish engulfing candles and these trading strategies. And now there's so much money on Wall Street. The big trading desks have a lot of capital to be able to run stops and all that. So, again, you don't want to give it a 5% stop loss. It's just slightly above, especially on an intraday basis, very much so. In other words, what does that mean? They could pop the top, let's say today or Tuesday, and gap up and then reverse. And it looks like this. We pop up on Tuesday, make a slightly higher high, but then put in a big red candle. Imagine that's red, not blue. And that's going to have the same net effect. So I would look for, either a very solid intraday break above there. And again, it's all relative to your targets. Solid, you can give yourself, if you shorted it yesterday and you're targeting down here, as like I told you, you can give yourself a 4 or 5% stop loss if you want. But I'd say relatively tight, especially on a solid or any daily close above there for that matter. They'll probably just pop it intraday if they're going to, but they haven't done it yet. So that's that. SPY, S&P 500, still very much comfortably below yesterday's bearish engulfing candle. PPO still rolling over, still below the trend line. So check. So to reiterate, right now with the S&P being up, it's 0.72%. It's still an objective short entry with the bearish engulfing candle still very much intact, and it's even a more favorable entry price. Yes, today is Friday. Not only is it Friday, I say that because swing traders, Friday is the one day of the week that whatever you take home, you've got 2 days of overnight risk, 2 extra days instead of 1 because you're heading into weekend. And now it's a 3-day weekend, so you're going to have even more overnight risk. And so, to factor that in, if it's not your cup of tea, you want to wait and see, you want to be the second mouse, the saying says the second mouse gets the cheese. You can wait and see if we start taking out yesterday's low. That would increase the probability of these bearish engulfing candles proving to be topping sticks, and we'll go on to hit my deeper targets. And it cuts both ways. There is a potential, let's say we gap down big on Tuesday, and you may not want to chase a 3% gap down or whatever. I'm just saying that's, not that it's going to happen, but sometimes that's the downside there. So that's that. There's your update on SPY. I think I already covered the 60-minute chart for you. And yeah, that's it. Oh, maybe I didn't. This is a 60-minute chart of SPY right there. That was at those highs right there. Very, very good resistance. There's your breakout right there above it. And so that was that perfect back test again. Just like NQ back test at the top of its trading range. So the market's bounced today, where the buyers should have stepped in and did so far. And the $1 million question is, can they keep it going, or are they going to fade this today and or next week? Which would be based on everything I covered yesterday, what I believe will most likely happen. Let me put this up here. Okay, so now yesterday I covered a handful, about a dozen, maybe a little less than a dozen of stocks that made new 52-week highs in the NASDAQ 100. And of those, the dozen or so I covered, the vast majority of those had put in bullish engulfing candlesticks. Not all, but the vast majority. And of those that did put in bullish engulfing candles, the vast majority were in the all-important tech sector, including quite a few semis. And so I'm going to follow up there today. So we're going to go over all the ones that put in the bearish engulfing yesterday very fast, show you update where they are. Applied Materials, AMAT, still very much under yesterday's high. So that that potential sell signal is still intact. However, you want to really increase your odds on shorting AMAT and or the semis. You've got beautiful price support at 214.63. It was these multiple highs, and then they broke out recently, and an uptrend line. So I think I already did it, but if not, like I like to do, can't hurt, set another alert right there. So this is the BOD level. The trend line in itself, that trend line break should bring in the sellers, and especially a solid move and or daily close down below 214.63. And then there's still that key level right there, and a bunch of other levels I have, uptrend line, all that. So we'll see if it triggers next week or whenever it triggers. If I get that alert, and it happens soon, especially if these bearish engulfing stay intact, I'll do an update. If not, if we go on through, guess what? Well, that's no longer a potential topping stick. And we don't have a sell signal on the trend line break. We don't have a sell signal of failure of the breakout back below 214.63. And that's how it works. AZN, AstraZeneca, yep, still below the bearish engulfing candle. Where it is? There it is. Again, not a tech stock, but one of the components of the NASDAQ 100 that made a new high yesterday and put in a bearish engulfing candle after doing so. Costco was the next one. Costco, that one has taken it out, and that's a pretty solid move right there, and that's worth noting. And so there's one that is no longer a bearish engulfing candle, but that's one of only a couple here. So I just wanted to point that out. We still have the divergence, but as I say, divergence is not a sell signal, nor do I see really anything. The best I can do, since I don't have a clean up trend line, is say, there's that previous high right there. There was an island top candle, and you did have a nice correction after that. Then you went on, tested for about 4 days, and then broke out. So that would probably be the most important level on Costco right there, in the near term, 768. CTAS, Cintas, I think it's pronounced, divergent high and bearish engulfing candle, nice follow through. So, down 1.64%. And then even all the better if and when it takes out this uptrend line I covered yesterday. And I'm going to give you one little horizontal support level. You've got right here with support. That's an important level. Then you have a gap right below there. You can either put the gap there or where it closed. So I'm going to put it right there. And those are potential targets if anyone took that one or wants to take it, again, on a break of the trend line. So there's another one. Still the bearish engulfing is intact into it. Very much so intact. In fact, if you took it yesterday on around the close when that candle was finalized, into today's lows so far, it dropped as much as almost about 9.5%, right down to that reaction low. That's probably where I should have put a level, and on hindsight, I'm going to do it because reaction lows are areas traders always focus on. So it's pretty much, and the 200 days, but are just below. And I still favor, this is the target I gave you yesterday, and I still favor it 55.85 and the 200-day moving averages, especially with that, confirmation right there, the bearish engulfing. So there's one that very much played out, and that's a pretty big name there into it. And ultimately, here's an uptrend line that will most likely be visited in the coming months, especially if the stock market rolls over and we take out the 200-day moving averages into it. KLAC, one of the big chip equipment makers, divergent high and bearish engulfing candle yesterday was still intact, but just like AMAT, you've got a nice clean uptrend line, aka the rising wedge, in which to trigger an even better short entry. And then I'm going to give you one more important level right there, and that was this level right here. Why did I do that? Well, I already had a line there. You can see we had several highs there, and we had a trading range, just like NVIDIA and everything else. We had a pre-NVIDIA earnings, earnings season whipsaw down below, back into the trading range. Then they kept tested for about a week, the top of it, and boom, big green breakout candle. So this level, I'm going to set an alert on both, is an important level on KLC. So this is your first sell signal. I mean, yesterday's bearish engulfing candle, and you can, again, that's first one. Trendline break is the second one right here, the wedge break, and then 727 should be lights out, take us back down to the bottom, and then ultimately down through based on the scope of the divergences, and back down to the 200-day moving averages, just like where I think the equity markets are going in the next couple of months here. Alrighty, MCHP, microchip technology. Pretty much testing the high of that candle, so it hasn't really taken it out yet. Again, if you have to squint, maybe by pennies, but it's for all intents and purposes, we're testing the highs of yesterday's bearish engulfing candle. And if we close below it, the highs of yesterday's candle, I'm going to consider that still intact. Micron, still intact. Yesterday's bearish engulfing candle, nice, clean, beautiful wedge. And again, like so many of these semis that I've covered in here today, the chips and the chip equipment makers, you've got pretty clean, well-defined uptrend lines and some nice price targets down below the target. So boom, second target, if you enter the gap, then you're probably going to backfill the gap. There's the bottom of the gap right there. So these are your price targets on Micron. So yesterday was an objective short entry with a stop somewhat above yesterday's highs. Short entry number 2 on a break of the trend line. Or game that. Well, they'll buy it there. Then, and when that goes, they'll most likely buy it there, I should say. If and when that goes, 95, 96.50, and at that point, when we get there, these 200-day moving averages right here should come in around that level. And let me give you one other target in case we punch down. There it is. Okay, so 89.86, and then my current max target on this one, right there, the uptrend line. So T1. T2, T3, and T4, the uptrend line right there. That is Micron. 2 more. QCOM, Qualcomm. That was also one of the bearish engulfing candle, or all the 52-week high yesterday. That one's taken it out, so nothing to say there. It's taken out. Again, the vast majority have not taken them out. Only a couple have. The reason I do these long-winded videos is I take all this stuff collectively. It's not any one thing. It's not one bearish engulfing or on SPY or QQQ. It's the fact that indexes, by the way, first and foremost, much more important than any one stock. It's the fact the index has put in those bearish engulfings. And again, like I said, if they get taken out in the next week or two, that's it. So be it. They put them in before and it didn't prove to be the top. And they put them in before and that did prove to be the top. So time will tell. All you can do is, take objective shots and, especially when you have those favorable RRs, with very minimum loss potential. This one, again, that's why, like I said, it's, if you want to play it safe on a lot of these, either no position or only a starter position until you have these BOD levels, the benefit of the, in fact, there was no support. This is the first and only support below this stock. This stock doesn't have any support, in my opinion, to right here, and that's now the first target. So there's your T1, 176.50-ish right there. And that was the top of this range, so resistance, and then boom, there's your breakout candle gapped up above it, successfully back tested, off to the races. That would give you, again, depending if and when the stock broke down from where it is now, that's about a 16% drop to that level. That's Qualcomm. VRSK. That one still below the bearish engulfing candle from yesterday, still has the divergent high, and still very much below the bearish engulfing candle. Okay, let's just take this video home with a quick overview of the stocks that I refer to as the formerly known as the Mag 7. It's pretty much the Mag 1 now, in my opinion, but we'll see. I mean, we can't call Microsoft still magnificent. It's a day off its previous, its 52-week or all-time high. But I just wanted to update it. How did I not cover? Oh, no. Yeah, this one should have been in there. I must not have added. I was looking at the symbol tags in the post yesterday. Yeah, this was one of the ones, and thank goodness I'm covering the fangs because I didn't just cover it. It was one of the ones that made a new high yesterday and also put in a bearish engulfing candle. And as I said in the video, the most important of them all because it has the biggest weighting. So nothing big. The stock's up today a little bit, but it's still comfortably below yesterday's bearish engulfing candle. And in fact, it is back testing the trend line. It broke below the trend line today, and it is currently back testing the trend line from below. So we're going to look at these on just a daily and a 60-minute time frame. And this offers an objective short entry. Let me repeat, Microsoft right now offers an objective short entry as a bearish engulfing candle. I'll consider this an active trade on the site. There's your first target right there, 119. That's the bottom of this trading range here. That was the big, trading range. Microsoft broke down when QQQ broke 433. Microsoft bounced when QQQ hit T2, and that's the bounce. There was your uptrend line, very clear, well-defined, negative divergence, breakdown, backtest. Again, the RR is just excellent on this trade because if you take out the recent highs, you're only right now less than 1%. So let's just say you give yourself a 2%, 3% stop. Where do I think Microsoft's going? You had levels on that 60. I'll give it to you here on the daily, the top of the trading range. First target 417. That would be, and that's just a minor target. Let me just try to eyeball it here. I have to grab higher and stop higher. That's about a 3% drop. Next target 397, which remains a very important level to me. That's why I have it colored up yellow. The 200-day moving averages, and then this is a very, very important long-term level too, 364. All potential targets, 1, 2, 3, everything you see here except this, even this one, I have a light, it's 384.71. These are all potential targets for Microsoft. So let me rephrase that. So you have a roughly, I gotta turn the lines off, 1 second, guys. I already did it. 1% upside. Let's say you give yourself, let's just call it a 2 or 3% stop loss. And from where we're at right now, 430, I'm going to grab a little lower and then I'll go a little lower. The potential swing targets right here, that would be about a 7% drop. The 200 days and this price support here come in at about a 12% drop. And then down here is about a 15% drop. So, and I think that's based on this, I'll be honest, I think it's going a lot lower. I think it's coming to this long-term trend line. I know very few want to hear that or believe that, but that's my job, to just tell you my opinion, right or wrong. That's going to be down to that trend line in that 311. The trend line, by the time it gets there, if it gets there, is going to come in around this purple level, 311.56, 27% drop. So let's just say you have the gumption to do that and hold out for that and ride out, whether you want to game the bounces or not. Let's leave that out. You hold out and you're going to go swing for the fences on this one. That is a phenomenal RR of about 10 to 1. It doesn't get much better than that. And you can take those kind of shots and miss on 5, 6, 7. Then you get one of them out of there, and it's going to pay off and offset the gains on that. Will offset the losses. Like I said, because of the above average risk reward ratio. So there's Microsoft. Oh, let's do the other things. Apple still below the trend line. Apple, like I said yesterday, hit perfectly that 186.65 support level I had on there. Bounced, and it's still below the trend line, so it's still on a near-term sell signal. And this is a 60-minute chart. There was your wedge breakdown, divergent high. It's not written there, but I'll just borrow this one, duplicate. Covered it yesterday. Negative divergence, bearish rising wedge, breakdown, hit of support right there. And that fact, that should be on that candle right there. That's where I was on the daily, and that's what it hit, 187, bounced. And like I said, nothing goes down forever. Dip buyers, Pavlov's dogs, will do what they do. And so, I would think that next target there. And you have some resistance up here, and that's Apple. So as of now, just fresh off the breakdown with the first counter trend bounce. Next one up, NVIDIA. NVIDIA is kind of stalling out. It was up nice yesterday, but that's what it does on earnings. And so far, not much follow through, buying and trading about flat today. So really no update there. Alphabet put in a divergent high the other day. It's coming off that. Let's look at the 60-minute chart. Here's a potential uptrend line. I call it potential because there's only the low, that reaction there, and it's also potential target. And you had the divergent high, first support right there, and then the trend line, and then I'll give you one other level to watch right there, or target if you care. It's not my favorite, but certainly, again, if the market rolls over, these guys, birds of a feather, it'll go down in line. And if the market continues up, it's going to go on and either put in a new marginal new high, divergent high, or it'll go and eventually take that divergence out. So that's Alphabet. Not much to update there. Amazon put in a divergent high recently. It's been moving lower since. It has a downtrend line here, and you have a little bit of positive divergence right there. Now you're also coming off a much larger, bigger divergent high, and that kind of overrides it. So now if we pop this trend line, you'll probably get, almost certainly get a counter trend bounce. Where to? This is the first resistance that ideally, again, ideally, if we do break out and we do rally, and for the bearish case, we need to, be nice to see it get rejected off that 187 level and then continue down lower. These are all potential targets right there. Daily chart, again, shows the same thing. Divergent high, and here's your near-term downtrend line right there. All right, couple more. Meta still, major sell signal there. Divergent high, breakdown, earnings smackdown, rallied up back to this 479.70 resistance level. And that's where it remains. So below the breakdown, and not much else to talk about. PPO is down into bearish territory. PPO zero line often acts as a trend indicator. This is your zero line here, the dash line. And as you can see below, when the PPO is trading below the zero line, Meta is typically in a bear trend, primary bear trend, right? And when you cross above the zero line, as you did here, you're in a bull trend. You remained above it. When you're above it or below it, it acts as support or resistance. So, you want a short back test to it. Keeps the trend going negative, and when you're bullish, you buy pullbacks to it. But then when it crosses, it tells you that there's a likely trend change in place, and that's exactly what happened. And so you're below it. And so at this point, it's hard with the market and other stocks pulling this up like a vacuum or a magnet. But if you're just, again, being mechanical and unbiased, and you're going off what I'm pointing out here, others may see other things in the stock that are bullish. So now if it flips that back, then guess what? This was a whipsaw. That's it. Then that just makes it takes away a check mark for the bearish case. As does if the market continues to hold up in the majority of, again, I covered all these stocks because you have to look at it collectively, not just any one. What I mean by that is, can Meta go down if the other 6 go up? Yeah, I've seen it happen, but it is certainly a net tailwind for Meta when the rest of the, when the QQQ is when the NASDAQ 100 is going up. So, but as of now, like I said, there's multiple reasons to be short. The divergent high, the breakdown of that level, and the fact that we're backtesting resistance right now, and the fact that the PPO is indicating a trend change has recently occurred, a primary trend change. Alphabet I already went over. That's the other share class, 60-minute chart. Let me see if I had it. This is a little cleaner version of the Alphabet on the other share class. Uptrend line, divergence line right there. There's your divergence. I usually mark up GOGL instead of this one, but the charts are the same, of course. AVGO, Broadcom, really not a Mag 7, but up there, one of the top components of the NASDAQ 100, and just big divergence, been building, and that indicates to me that when we finally get the turn and we start to take out, like this is a big level. Here's that trading range so many things have. We're at the top of it now. You break the bottom of it and this purple uptrend line, based on the scope of these divergences, which, and it appears to me a breakdown is likely imminent relative to the time frame we're talking. It's a daily chart. So imminent doesn't mean minutes, second, or even days. It means weeks or months when I'm viewing a daily time frame. And so, boom, that would be a major sell signal there. Set alert. I don't already have one. And targets 1042, 924, and ultimately maybe down here to 787. Did I give you the 60 on it? Yeah. I have a note here. See 120-minute chart. So why? Because this trend line right here has to come in. That's a nice clean trend line. I think it's the same one I just showed you on the daily. I'm not sure. Either way. So you have, even on this 60 and 120-minute chart, divergent high. No sell signals or anything, but it is flirting with the top of the range. And so if it gets rejected here, the midpoint of the range is your first support, 1308. Then the bottom of the range, 1200. And then the trend line, and so forth. So boom, meaning reactions, and then boom. All right. And one more, because we consider Tesla one of the formerly known as Magnificent Seven Group. And dead chart, to me, is really not there. You know, I pointed out back here recently that Tesla and Apple were the two best looking of the Mag 7 stocks, in my opinion, because they both were the only two with divergent lows. All the others had divergent highs, and they've outperformed relative because of that. And the technicals, the rally off that divergent low in Tesla was 44%. And when we got there, right here, I said, if you're in it, if you took that one at the divergent low, highlighted it, this is where I'd be booking profits at 198.16. I wish I wrote it up there and did it, but told you that's where we would likely reverse, and we did. And so if you took advantage of exiting there, you sidestepped a 15% give back after a 42% rally. But now I have no opinion. I mean, here we are. We're on support. I have a level at 175. We've kind of sliced through it a little bit recently, but I just don't have a strong opinion on this one. All I can tell you, it's in a, well below the primary downtrend line there. That's what I can tell you. So kind of in no man's land is what I call it when you're between support and resistance. All right, long video, but probably might be the last one for the day unless anything big happens before the close. I just want to update crude oil. Crude is slightly below that trend line, but still has that big divergent low, so positive divergence that is. And I still like crude very much, and still maintain that it has to break this downtrend line to run. Last time I mentioned it was at the trend line, pull back. Pretty much been testing these recent lows, keeping this divergence is even getting stronger, meaning the slope is starting to increase on that recent low. And so, boom, it still offers an objective long. It's kind of come through the trend line a couple times. It's not as valid anymore because you're piercing it here on these lows, but still needs to break that level. That would be a buy point. And then again, over that about 79.50 to 80-ish level. I'm going to put a second line there because we had a reaction high just above it. You can see here at about 80, and also reaction low there. So this is a resistance zone, and it's right above the trend line. So pop that, you go to 81.50 and then 83.60-ish. And then nat gas has pulled back to the T5. Remember on the futures, I gave you this 120-minute chart. We were buying it here off there on the breakout as well. T1 hit T2, 3, 4, 5. Went up, put in that divergent high recently. So we expected, pulled back and hit the trend line. Did bounce off the trend line and actually took the trend line out. And we're testing T5 now, right now. T5, I could lower T5 a bit. I left it where I had it before. But you can see I was a little above that reaction low. I was coming on here. And so it's at that level now. So for all intents and purposes, it's still back testing support. However, it's taken out this trend line, and we're coming off that big divergent high. So I want to let you know I am not re-entering it. I have closed my short today, closed my short this morning, and I'm going to sit tight and if it gets back down here, I will probably be a buyer, especially if the charts confirm. And who knows, I may re-enter it. Let me show you how constructive the daily charts look here. Now, I've covered this before, back when we were at those lows, telling you it was long-term support. Marking it up with let me get a different color here so you can see. This is long-term support, so the case was made there, and you just got to love these divergent lows. I mean, natural gas trades so well to the technicals. You get divergent lows. That was a divergent low. That was a divergent low. So these are going back. We're going back to 2009. This is my weekly chart of natural gas. And again, I covered this, back when we were, make the case to go long. These are all go well into double digits, 40, 50, 100% plus rallies off these divergent lows right here, especially that one there. And then the same thing in reverse, the divergent highs. Get out of Dodge, short natural gas, boom. And so what I'm trying to show you here is, we're just fresh coming off that divergent low at long-term support. And so longer, and look, we hit on that previous run. This is a support resistance zone. I've had this here for years. I added that back there. And so we'll probably get there, but again, maybe a little more downside in the near term to right about there, 250 or so. And then, but again, this would be relatively small based on the history of natural gas when it puts in these. And again, this is a weekly time frame, guys. This is not a 60-minute chart, even a daily. So this is kind of shows you the trends. And again, so at this point in time, like I said, stepping aside, milked almost all, a good part of that 50+% run, turned around, got a little bit on the short side recently, but not, relatively not too much. And I'll wait to re-engage. And like I said, sometimes natural gas can just keep going. But at this point in time, like I said, they're probably going to be a little more downside, being that we took out that trend line. And then I'll let you know when I think it's time to get back in. Okay, we're just under the 1 hour mark. Remember, you can always play these videos back on 1.5. I like 1.75 times speed when I watch just about any YouTube video. You can play around with the numbers, 1.5, and it makes them go through a little quicker. And like I said, I'll try to do my best in the beginning of the videos to cover what I'm going to cover in what order I might have thrown in. Yeah, I didn't mention natural gas and crude. I just kind of towards the end of the video had a mental note to update those for you guys. That is it. This has been Randy Finney with Right Side of the Chart. Have a great day.